Hello, Bitcoiners. What's up? Ansel Lindner, Bitcoin and Markets, second live stream of the day. The first live stream didn't end up connecting to all of the platforms. It was a Telegram exclusive. So anyway, what I ended up doing for that FOMC reaction was I'm just going to plug it in here as a video, separate video, and then we're going to watch through that. Then I'm going to go on the press conference. Powell already from the press conference is talking about Bitcoin. We're going to watch it all the way from the beginning through, and I'm going to comment. This is going to be full of my brand of macro analysis, my macro thesis, and yeah, so you guys will get a taste of that. Let's just go right into that previously recorded segment, and I'll be back on the other side of it. So let's do it. Today is FOMC day, so we're going to see whether the Federal Reserve is going to cut interest rates or probably, the choices between cutting 25 basis points or keeping them the same. So we will take a look at that. Let me share my screen and we'll get right into it. We're only 1 minute away. And I'll give you guys my live reaction. So this is the FOMC calendar. You can just Google FOMC calendar and it comes up here. And we're looking down here at the December meeting. And I will refresh every now and then to check on that. One thing we did in our pregame show real quick before going live over there on Telegram was this from the CME, their FedWatch tool. And it's a 98.6% chance that they'll cut 25 basis points. What I had said earlier is I think the risk is actually to the downside here, towards 50 instead of towards 25, because Powell's looking out around the world. He's seeing China having real big issues, Germany having real big issues, unemployment ticking up here in the United States. Somme rule has been triggered. Yield curves are uninverting. Everything is pointing towards a slowdown. All that's required right now is like some slowdown event to happen to really pull us into recession. And I think Powell sees that. So that would match 25, but it would, with a skew to a risk to cutting 50 and not 25. A lot of people are saying that they're going to cause inflation if they cut too much, but that is not the case. And we will talk about that a little bit more. Okay, so FOMC has come out. So let's take a look at the statement. I'll zoom in here a little bit. So the committee decided to lower the target by 1/4 point. So they dropped 25 basis points down to 4.25 to 4.5%. So that is what they have done. Right on expectations. So recent indicators suggest that economic activity has continued to expand at a solid pace. GDP numbers have, okay, so if they're just looking at like GDP numbers, but if they're looking at the New York Fed comes out with their own PMIs and their own like industrial output and all this other stuff, and all of those things are looking very, very poor right now. So really, they just have to be looking at GDP. And this could also be just, the main job of the Fed is not to mechanically move things around. It's to build a narrative and to influence markets. And so you have to read everything. I think they're not outright dishonest, but they do try to massage what they're saying. So let's continue on here. Since earlier in the year, labor market conditions have generally eased. So yes, but they say generally eased instead of gotten worse. And the unemployment rate has moved up, but remains low. Now remember the Somme rule. It's named after, I think it's Claudine or Claudia Somme from just a few years ago. She put out a paper, maybe 10 years ago. And she went back and back tested this. So I'm not sure the exact moving averages now, but it's like the 6-month moving average of unemployment when it surpasses 0.5 basis point higher than the lowest 6-month moving average of unemployment. So it's based off 2 different moving averages, and when one increases above the bottom, then you have a recession is guaranteed. It's actually a real-time indicator, meaning that you are actively in recession in hindsight. So that has triggered months and months ago already. The yield curves, the 2-year, 10-year, and also the 3-month 10-year have uninverted, and that typically happens or has happened every time before a recession for the last like 40, 50 years. So these two things are the main base cases for why we're going into recession. So they say unemployment rate has moved up, but remains low. Yeah, it remains low until you get a real big spike. And there's also questions about whether unemployment rate has been massaged from the current administration, and perhaps we'll get some large revisions going into this January, because that will saddle the next administration with higher unemployment rate. So there you go. Inflation has made progress toward the committee's 2% objective, but remains somewhat elevated. That's true. The committee seeks to achieve maximum employment and inflation rate of 2%. The committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Okay, so I think that's new language in this sentence. I think previously they were saying coming into balance, and now they say that they are roughly in balance. This is a dual mandate, guys. So most of you watching this are going to be familiar with the dual mandate, but if there are new people watching that are new to like Fed watching, there is a dual mandate by law. They have to target maximum employment and stable prices. And so they pick this 2% as stable prices. And this is not arbitrary. I mean, it kind of is arbitrary, but it's an educated arbitrary number here. 2% is because, for one, the monetarist school, like if you go back to Milton Friedman, and he was pretty much the last great economist. I mean, you could say Hayek or Rothbard, but Milton Friedman was kind of like the last great new thinker in economics, and he was a monetarist from the Chicago School. And they said that if they do monetary policy based on data, so like the Fed says now, they're data dependent. If they do monetary policy based off data, they will always be behind, because the data inherently has a lag. And then their monetary policy, once they do it, has an inherent lag to being fully kicked in, right? So you're constantly behind, and that's no way to do monetary policy. Then you have to start, forecasting based off forecasts instead of based on actual data and guessing what's going to happen in the future. So what Milton Friedman said was, hey, we just have to target a consistent growth rate of the monetary base of the money supply. And that will, yes, it will cause perhaps some boom busts a little bit, but overall it is not a data dependent thing. It is just a theoretical move. You're going to just slowly increase the money supply at around 2%. The other, I think he said 3%, but the other thing is the inflation rate under gold. So gold actually is inflationary. A lot of people say, oh no, gold is deflationary, but gold is inflationary in that it has a 1 to 2% increase in supply every year. 1 to 2% more gold is dug out of the ground every year. So a gold standard is an inflationary standard, roughly 2%. So now if you add these two things together, if you say, okay, well, what would be an inflation rate under gold? It would be about 1 to 2%. Milton Friedman and the monetarists, nowadays they're neoclassical economists that are at the Federal Reserve, but it's not really a set school that's very prominent. Anyway, so the Milton Friedman would say 3%. So then you kind of take the average of that, and that's around 2%. So that's why they target something like 2%. They probably have some more academic sounding reasons why it's 2%, but that's the general idea. So the committee judges that the risks to achieving its unemployment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to risks on both sides of its dual mandate. Okay, we read that. What about the quantitative tightening that they've been doing? The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning its inflation. Okay. All right, guys, welcome back to the live portion of this stream. That was a replay from earlier with my technical difficulties, I just recorded it from Telegram, popped it out. So that's why the quality of the video is really bad. But welcoming John Delaney to the live stream. If you guys are watching YouTube, Rumble, Twitter, Telegram, Twitter, jump over to the Rumble or YouTube. It's easier to chat there. Put your comments, questions down below for all of this. Anything I talk about here, you guys are welcome to push back on. We're all learning. I do have a degree in economics and a background of a decade in Bitcoin now. Before that, a decade in sound money with gold, being a gold bug, Austrian school. So long time economist type macro guy. And I have a very unique macro thesis, and it revolves around, it describes why Bitcoin will be adopted globally, which we're seeing the game theory kind of playing out right now. But Powell is part of that. Powell is, head of the most important central bank in the world. What the US does with the monetary policy is extremely important. And so we need to watch this, digest it, make sure that it fits in with the macro thesis and not just kind of taking the facts and post hoc. The direction is different. So most people, they have this inflationary mindset and they interpret everything with that inflationary mindset. Well, what I do is I took the facts and I built a macro thesis around the facts, and then each time, and then I use make predictions with those with that thesis, and then I take real data like the FOMC meeting here and rate cuts and interest rates, Bitcoin price, dollar, everything, and make sure that that fits the macro thesis. But my thesis is malleable. I'm willing to change my thesis, where most people are not willing to do that. They're willing to say it's inflation, inflation, inflation. And then they go through a decade or 15 years of almost no inflation, no price rises. And then we get 1 year of high inflation that happens to be when we shut down the entire global economy and the entire supply chains of everything around the world. And they say, look, my inflationary thesis was correct. Well, no, it wasn't. It was just a one-off. Okay. So anyway, I'm venting a little bit. I wanted to check the charts real quick, and then we're going to go into the press conference. I'm going to start the press conference from the beginning and react through the whole thing. I go on my tangents. But okay, let's share my screen, and then we'll check out some of the charts. So here we have the Bitcoin price in this channel. On Monday's report, I did mention this channel. I didn't think that it would be all that much resistance, but coupled with this FOMC meeting and the comments made by Powell at the FOMC meeting, which we'll take a look at here in a second, that Bitcoin price is selling off probably to the bottom of this channel. Let's bring up some moving averages. Let's see, what is this one? 50. Let's take a look at the 20. Okay, so we have the 20 period moving average at the bottom of this channel. We'll see if we get some support there. I think that would be a very good place for support. But think of it this way, guys. None of the fundamentals changed between yesterday, or really since this big day. What was this? The 16th? Was that Sunday night into Monday morning? None of the fundamentals have changed since then. It's just that we're at a point where we needed to have some more consolidation. So we're coming down, and it's not like this is the end of the bull market or anything, or even a major top. I don't think it's going to be any sort of major top at all. So we just have to find some support and continue going higher. MSTR is going to be buying. All the normal people are going to be buying all the dips. So I don't expect any big dip to happen. And let me describe how that happens. So when big players are going in and they want to buy like 500 million worth of Bitcoin or even $1 billion worth of Bitcoin, they can source it at over-the-counter desks. It depends what their strategy is, but they can also go into the markets and just place bids below the price, because what they don't want to do is fat finger a $5 million buy and the price slips away from them all the way up. They eat through the order book and it goes all the way up, and they end up buying for 200,000, then flash crash back down to 100,000, right? So they don't want to do that. What they do is they'll set orders and they'll just collect all the Bitcoin on a 5% drop. And that's what they're going to do here, in my opinion. So we're not in any danger of like a really big sell-off or anything like that. We should just look for these very near-term supports are probably going to be quite sturdy for buying for support on the price. But okay, that's what's going on with Bitcoin. And then the stock market, huge down day, slashing through the 50-day moving average. But this was the level that we were looking at to get support. Below this, we had to start paying attention. And then once we break this one down here, which we've been watching as well, that's when, we could say, okay, we're in bear market territory. How far down is this from the top? If we just go down here, I mean, that's only a 7% sell-off. I mean, Bitcoin, we're kind of in our own little world. 7% is not much, but for the SP 500, that's a pretty darn big drop. So anything over that, we got to start thinking about, is this the beginning of a bear market? All right, so that's that. And one that has surprised me a lot is this. This is the US 10-year. And I'm surprised that this is going higher, especially as the Fed is cutting. The global economic situation is very, very bad. So people from all over the world are going to be going into US Treasuries. Some of the recent bill auctions, so we're talking the 1 month, the 2 month, 3 month bills, have been 3 times oversubscribed. That means if they're offering $7 billion in 3 month treasuries, they actually have $21 billion worth of bids. So they're oversubscribed by 3x, and it's usually around 2, maybe 2.25, but this is 3x. And so there's a lot of demand for the short term. And I'm surprised that there's not more demand here for the 10-year as well. But this could just be a blow off top that it'll correct after this. Overall, my thesis is U.S. all yields will fall as we go into recession. And I have no worry of a reacceleration of inflation. Here is the dollar going stronger. I put this path down here when I drew this descending wedge, probably on December 6th or 7th. Yeah, December 6th, probably on Friday is when I drew it, because I talk about the charts on Friday. And I drew this breakout here, and so far it's doing that. I expect it to continue to get stronger. So this is not a path towards reacceleration of inflation. This is a stronger dollar. And that, of course, that corresponds with a weaker euro, a weaker pound, a weaker yuan, a weaker yen. Everything is going down. I tweeted today, somebody showed a chart of, let me look that up real quick. Somebody showed a chart of some other macro shop that was talking about de-euroization instead of de-dollarization. So here it is. So bar chart, he tweeted this from Gaveco Research. And the title of the chart is Data from SWIFT Suggests De-Euroization is the Dominant Effect. Well, you go back to August of 2022, and I say, forget about de-dollarization. The world is rapidly approaching de-euroization. So that's what I expect, is the dollar to get stronger and all of these other currencies to get weaker. That it's along the lines of the dollar milkshake theory, but it's more into an evolutionary mindset where the dollar system is dying, but dying is getting stronger in this case. Because think about this, the entire world is a debt-based system. If the dollar gets stronger, that's bad for the debt-based system. The dollar getting weaker is good for a debt-based system. It makes debt easier to pay off. That's why I say for the Fed to lose is deflation. If you get inflation, the Fed is winning. They're fighting deflation. They're not fighting inflation. So in this case, with the dollar getting stronger, that's actually really bad for the system, for the overall longevity of the current credit-based US dollar system. So evolutionarily, once that starts dying off, what takes its place. We're starting to see the glimmers of Bitcoin taking its place. And we talked about this in Telegram. DT had a great comment about how the dominoes are starting to fall. The game theory that how can the U.S. not get a Bitcoin strategic reserve if the UAE and China and Russia and those, the game theory is for everyone to get a Bitcoin reserve, and in that case, that's one step closer for Bitcoin to be the global reserve asset, right? So the game theory is progressing down this road from a strengthening dollar that's malfunctioning the system because a stronger dollar is bad for the system. And we're pivoting towards a Bitcoin as a global reserve asset. So that's the whole kind of idea here. All right, that's enough of that. Let's go on to the press conference, shall we? So I have it queued up for the beginning of the press conference. This was it did start over an hour ago. It's been done here for about 15-20 minutes. He does make one big comment. The way I like to roll with these is I let him speak. The first part of the press conference is always a boilerplate. But he also, that every 3 months, they have a new release of the summary of economic projections. That's where you see the dot plot and you see what they think is happening with GDP and inflation and unemployment and all that. So we will pause on those parts for sure, and I'll make my comments throughout. But and then the question and answer period, I usually just do the front row, but there was a question from the back row. Maybe we'll try to catch that. Make sure we include that in this commentary. Okay, so crank up the volume. Usually it's quiet, so I'm going to make it loud. And let's go. He should be walking out any second. Actually, sorry. Well, he said good afternoon. The closed caption said that there was a market on Polymarket if he was going to lead with good afternoon. I just wanted to check the comments before we get started. Justin in the house, what's up? Check on DXY, it's going insane. Yep, we looked at that. Let me check Telegram, see if there's any comments. Joaquin says gold is on the Fed's balance sheet, but it's physically stashed at Fort Knox. So gold certificate. Okay. Yeah, he says in here when they mention that about owning Bitcoin, he says it's mandated by law. It probably says something about gold in there. Phil G. All right. Yes, the 10-year 3-month has a strong uninversion breakout. Yep, for sure. And that's really bearish because especially that one is closer to recession. The 2-year 10-month uninversion. So when the inverted is when the longer bond is below the shorter bond, because usually it should be the opposite in a healthy economy. So if it's below, that's an inversion. Uninversion obviously is when they cross again and go back normal. For the 2-year 10-year, that's usually about a year or so ahead of a recession. The 3-month 10-year is shorter than that. I'm not sure the exact average, but I would say something around 6 months. Okay, so it's more imminent, and we will definitely be watching that. We've been waiting and waiting for this pre-recession trade to get over with. Of course, the pre-recession trade is what I've been talking about for about 2 years now, and that is Bitcoin up, dollar up, stocks up, bonds up. And bonds really, so they topped out, they bottomed in price around October of 2022, I think. So they didn't really get going until this, the second half of this era that I was calling pre-recession trade, but the bond part will pick up big time. And then the imminent recession trade is going to be negative stocks and positive bonds, positive dollar, And we'll see what happens with Bitcoin. The way things are going now, and people are getting strategic Bitcoin reserve, that puts Bitcoin in the same bucket as treasuries. So hopefully it won't be a big sell-off. Hopefully it's moving from the stock market kind of risk-on asset, which don't want to go into that, why that's not really the case, putting it into the bond basket. So Point says, my understanding is the Bitcoin reserve would be held by the Treasury and not the Fed. Yeah, that's what I understand as well. Okay. Now we can get into the press conference.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid.
Okay, so these are the charts I was talking about. Sorry for the volume. That's as high as it goes. Here we go. So actual here, projection here. Notice the error bars. This is like where all the people are sitting. This is the range of projections. And notice how tight it is. This is probably less tight than previously, but there looks to be some uncertainty increasing right here in the 2026 year, which is interesting. They have very tight on 2024. Obviously, we're at the end. We have 1 quarter left. 2025, and then 2026 continues to expand the uncertainty range. So that is interesting how that is, even though the median, which is the red bar, is continuing to go down, but notice around 2%. So you'll notice that 2% in a lot of things. You're noticing that in GDP here. You're noticing it in their target. You're also noticing it in, so their target for inflation, and you're also noticing it in their projection probably for inflation. But yeah, that 2% number is all over the place. Okay, let's continue.
The median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years.
Okay, so let me go back a couple seconds here. So here we go with the unemployment rate going up slightly this year. Of course, we just have half a month left, expanding the uncertainty out all the way, actually, if you look this way. So this is a little bit different than GDP, but really just very flat. Okay. And I've talked about a lot in previous reactions to Powell and previous reactions to the SEP specifically. And that is, all of these things are just like best case scenario. None of them really take into account any sort of problems, any sort of unexpected events. Okay. And those are hard to predict, but you can see what's happening with interest rates. You can see what's happening with other things. And you could say, okay, well, these are you can do some analysis on the actual chart itself and be like, okay, well, looks like a blow off top. Right now we're lower than we were here. What does that mean? Et cetera, et cetera. And you could say, okay, something's probably going to happen in the near, like maybe 6 months to a year. Looking at the recession, you can look at uninversion of the interest rates. You can look at the Somme rule again. You can look at all these other things and say, there should be some uncertainty around this. Also, if you look at how it started to tick up and you look at unemployment generally, if you have something that's starting to tick up, like from 3% to 4%, it doesn't stop there. That an uptick in unemployment is a sign of deterioration in the economy, and that compounds on itself, and you're going to get a spike. Now, how high does that spike go? Who knows? I mean, right here in 2020, they have only 6.5%. When it got as high as I think it was like 14%. I don't know. It broke all the charts. But anyway, that's what we're looking at here. Projection, no uncertainty really. It's pretty tight. And he said something else there, that it's not going to cause upward pressure on inflation, which is something he's been saying all along. Because, a tight labor market can lead to a wage price spiral where people are getting wage increases so that employers can keep their good people. And so wages are going up as prices are going up. And that's what's necessary to maintain an acceleration of CPI, an acceleration of prices. As prices go higher, you have to give people the ability to afford those higher prices, or it turns around the other direction and it causes problems. It causes savings to be drained. It causes defaults, both on the personal level and on the company corporate level. And so that's why I've been saying all along that there's going to be no wage price spiral. The higher levels of CPI were temporary or transitory because of this very dynamic. What gives people the ability to raise their wages? Well, you have an expansion in credit. You have money printing going on in the economy, and we really didn't see that. Okay, so that's why we knew all along it was going to be transitory. Let's continue.
Year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2%.
Okay, so the projection is 2.4. Currently, I guess PCE also has November and December left. So we got to have, with the base effect, we're going to get some undershoots. They're projecting we get some undershoots probably to PCE in coming months, and it drops another 0.1%. Interesting. Okay.
Objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.25% to 4.5%.
Okay, so that doesn't quite match. If it's balanced, wouldn't you just stay steady and not cut? So by cutting, you are actually saying you're not balanced. You're more towards fighting unemployment in their school of thought. You're more towards fighting unemployment or the rise in unemployment than you are in fighting inflation. So that kind of right there is a little bit inconsistent. And I think there's some other things that come out here, maybe in the Q&A. I saw a few notes on Twitter. But anyway, let's continue.
We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision.
All right.
As the economy evolves, monetary policy...
Let's look back at that dot plot and take a quick break to take a look at comments. Also, guys, watching on Twitter, jump over to YouTube and Rumble. You can make comments over there. Let's see if there's any other comments here. Nope. Put your comments down below, guys. Let me check Telegram. Nothing new over there either. All right, so dot plot. This is pretty much what we should expect because this is the last meeting of the year. How do they not all line up? How do they not all line up? Were there multiple people going against the decision today? I'm not sure how many voting members there are, but there was one person that voted against the last adjustment. And are these people voting against this adjustment? I don't know, but how are they not all lined up on one line? It's the very last meeting of 2024. Okay, and then 2025, he said 3.9%. That means 2 rate cuts next year and 3.4, so 2 more rate cuts in 2026. That is very wishful thinking. Again, all of these are the best case scenario. So they should, instead of labeling these economic projections, they should label them best case scenarios. Because if we have a recession, this is thrown out. And there's a lot of charts out there that you can see the history of these projections, the histories of the dot plots that aren't that old. I think they go back to the Great Financial Crisis, but they're always wrong. They're always wrong, both on the way up and the way down. They're always wrong. And so this will, if it's going down here in this economic projections, most likely it's going to follow a much steeper path than what they're showing here. That's what his history would say. Let's see if I can find let's see if I can find an image of that real quick. A good one. I can't find one real quick. You guys have probably seen it. Let me check Twitter and see if I can find one on there real quick. No, I can't find anything real quick. So let's just continue with this and make some comments.
The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate.
Okay, so I don't like that. I mean, that doesn't give me confidence that, oh, they're positioning themselves in the middle so that they can chase it down if they have to. That does not inspire that should be like, when we read through the statement itself and how I said their job is to create a narrative and to influence the market and to massage things maybe more positively. This is not massaged positively. It's massaged neutrally. And if it's massaged neutrally, then that means it's actually going to be interpreted negatively by the market. Maybe that's why we're seeing what's happening with the sell-off in stocks and all that. So anyway.
On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration.
That is not typical configuration. I saw a tweet about this too. So the reverse repo rate was usually 5 basis points above the bottom of the range, and it's been that way since it was introduced. So at 4.25%, the bottom of their range, the reverse repo rate would be 4.3%, but they're putting it at 4.25. What that does is it disincentivizes people to hold any balances in the reverse repo. So they're kind of pushing people out of that reverse repo, which is interesting move because I don't know what the balance is. Say it's 100 billion or a couple hundred billion. That pushes that out back into the banking system, and that could be a form of stimulus. Or interpreted that way. So very interesting what they're doing with the reverse repo. There's a lot of different policy tools that they can use. Some of them actually are mechanical, I guess. Like I always say that the Fed isn't mechanical at all, but setting that reverse repo rate down at the bottom of the range will have a mechanical effect. Not what they're doing, but it changes the incentives enough that reverse repo will drain back out into the economy. So very interesting. We'll have to dive deeper on that in the future.
Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable.
Well, one reason why he has to say that it's not going to cause any or have any influence on monetary policy is because it should be interpreted as dovish. Setting the reverse repo down to the bottom of the range, that is not normal configuration, is dovish. And I don't think he wants that to be interpreted as dovish. And so he will say it doesn't have any impact, but it definitely will have some impact for sure.
Stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Okay, my overall response to that, like an overall feeling, was it felt like they were trying to portray neutrality, that things are going according to plan. All of their projections are nice and smooth. Nobody's seen anything, but if there is a problem, we can adjust rapidly. Okay. So it's a neutral stance. But like I said, the neutrality is actually dovish. It's actually makes people more worried about the economy because they're not saying, oh, we see a rosy future. We see strength out there. We see some things improving and yada, yada, yada. So going back to my overall my overall impression of Powell in general is that he is fairly straight shooter. I think they did, they are cognizant of what they're saying and how it's coming across. But at the same time, I think some of his natural honesty comes through, and that is the market is going to interpret that bearishly, or in other words, on the dovish side of, easing the monetary policy. Let's take a look at any comments. No more comments there. Telegram. Okay, Joachim says SEP are not forecasts, at least not in any professional or meaningful sense. They are widely considered as a way for the Fed to do open mouth operations. Yeah, I mean they are billed as forecasts though. They're billed as projections. So but they are a tool of monetary policy, correct? They're forward guidance. That is a huge part. So there's different parts, I guess, of forward guidance or of the monetary policy, because they don't do anything really mechanical, is the SEP and the language that they use. In this case, the SEP could be considered very slightly bearish as well, because of the direction of some of those things that we talked about, with GDP kind of coming down and unemployment kind of going up. So some of those things could be considered slightly bearish on that sense. And I think he missed overall on the confidence in the economy on his rhetoric here. So yeah, that's what I would say. All right, back to the questions. Let's take some questions here.
Gina Smilik with the New York Times. Thank you for taking our questions.
Sorry, this is as loud as I can get it, guys. I'll try not to break in so that you'll know I won't blow your ears out.
I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see
if it's a close call, you don't want to miss to being more hawkish going into a recession type environment. So you want to miss on the being too accommodative in this particular environment. And so that's what I would say would be the difference in their vote here.
the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all
They're going to be behind. They're definitely going to be behind. Remember when I was talking on the pre-recorded first live stream about Milton Friedman? And he said that if you are data dependent, you have no option but to be behind. So they're putting themselves on a footing here where they're a little bit more dovish, but they're still putting themselves behind by waiting. Now, somebody would say, well, that's because they're in a hard place and they have to know where to set this and stuff. That's not the question. They're going to set it where the market is pricing it in. They don't want to necessarily surprise the market at this point. And so the question is on their narrative and how are they forming this story around what they're doing. And I do think that this is a miss. I think this is a big miss on setting that expectation and setting the narrative around this. Of course, I don't think anything they do would necessarily change the outcome. I think the market is larger than the Fed, and the Fed having to chase all the time and always missing a recession shows you that the market is in control. And so all in all, it doesn't matter, but I think this is a miss on their rhetoric around this.
All of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%.
The economy is growing at 2.5% because of the fiscal spending, because of the deficit spending that they're doing, and that government spending is counted the same as private sector spending. So if you gave that public sector spending a discount, I've said 15%, maybe 30% discount on that government spending, because we all know government spending is not as productive as private sector spending and private sector growth. Government sector growth is not as productive. So what is the difference? Well, there has to be, I'm sure these hundreds of economists at the Federal Reserve could do some study, and they could come up with saying, oh, we need to actually handicap the government spending by 15%. There you go. Well, then where does that leave the GDP number? So I'm open to revamping the GDP and revamping some of these other things. Other countries do GDP differently as well. So China is an input-based GDP, not an output-based GDP. So it's a gross domestic input, not a gross domestic product. And so GDP can be changed. And I think that would serve people really well in going into the future. I mean, GDP has to get revamped. It has to go, and it is the king of all economic indicators, though. And that would cause, it would be a big adjustment. It would definitely be a big adjustment, but 2.5% GDP growth when actually the government is running major deficits, it just doesn't make sense. We all feel that it doesn't make sense. We all know that it doesn't make sense. And so that really has to be changed, in my opinion. Let me take a break here, guys. 211 people watching. Ansel Lindner, Bitcoin and Markets. Thanks for joining. Hope you're having a good Wednesday. We're coming up on 59 minutes live here. This is my second live stream. I live streamed and we had technical difficulties, so I had to come back and do another one. This one, I'm adding on this reaction to the press conference. But I am live streaming on YouTube, Rumble, Twitter, and Telegram. So you guys can jump over there to YouTube and Rumble. It's a lot easier to make comments and questions and stuff. And check out the website, bitcoinandmarkets.com. That's where I put out all my stuff, including the most comprehensive newsletter in Bitcoin that comes out every Monday. Okay, so where were we? Fed, Powell, GDP. Yeah, I mean, I get frustrated with the GDP measurement. A lot of people get frustrated with the CPI measurement, and I do too a little bit, but I understand that, like, I view it as a good faith effort, and not 100% good faith effort all the time. I do think there could be some corruption going on, some fudging of the numbers in the short term, but I think in the long term, it all gets pretty much revised out, at least honest with their methodology. Now, do they have the best methodology? That's another question. But before you go and criticize the methodology, say, of CPI, you need to understand why it is that way. Okay. So, for example, the homeowner, what's it called? Owner equivalent rent. They introduced that in the 80s because houses were becoming investments. And so they needed to break apart the investment value of the house and the anticipated rent. So the anticipated rent, or the equivalent rent, so what you think you can rent your house for, is more in line with the cost of housing, where the investment aspect of it is divorced from the actual prices in the economy. So That's why they changed to it. And it's understandable. A lot of people don't like it because they think it underestimates inflation. CPI, it underestimates like prices and stuff. But there is a long history and rationale behind these things. So I think it's not perfect by any means. I'm not saying it's perfect. I'm saying that it's a good faith effort and it's understandable the way it is. Now, my big problem is with GDP because it is just so basic. It doesn't have this grand methodology like the CPI does. I would like it to be a little bit more rigorous in how they look at GDP and balance the different components of GDP. So anyway, that's what I would have to say about that. Let's see. Other questions?
Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. And
he's kind of stumbling here. He's too wordy. I'm going to skip forward. If there was any specific questioner that you guys see out there that you want me to listen to, I'll do that. But we're going to skip to the next guy.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, that considers situations in which it might be appropriate to see through inflation, and then names some conditions in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect, tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work, all of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy.
Okay. Blah, blah, blah. Tell me, how is monetary policy going to fix price increases due to tariffs? Just like how does monetary policy affect price increases due to a pandemic where you close down the damn ports and you break the supply chains? It does not make sense. That's the problem with calling it inflation. Now here he used a different adjective. So we have people that say monetary inflation when they talk about money printing. Then they say price inflation when they're talking about prices. And then they say tariff inflation when they're talking about tariffs. How does monetary policy fix tariff inflation? It's not inflation, people. Tariffs are not inflation. Price rises due to tariffs are not inflation. Inflation is money printing. That's what inflation is. If anything, tariffs have a deflationary impact. Rising prices can be deflationary. Rising prices from tariffs can be deflationary. I can go through the spiel again, which is what we kind of talked about with wage price spiral and why we didn't see a wage price spiral, because there wasn't that much actual inflation. There wasn't that much actual money printing. So prices rise, people can't afford it. What happens? Bankruptcy and default happens. That is deflation. So rising prices can be deflationary. That's what tariffs are in this system, in the current system. Same with high CPI above and beyond where the economy can accommodate it with more money printing. All right. So these are decoupled ideas. So you can't just talk about inflation and then slap a different adjective on the front of it, because you confuse everything. Are they supposed to, their dual mandate is stable prices. Okay. How are they going to fight tariff, quote unquote, tariff inflation with monetary policy? They can't. If they're more easy, if they have eased their monetary policy, it's just going to accelerate prices. So there is a deep contradiction, or is that the right word? Inconsistency in their theory, in their thoughts on this stuff. So I'm glad we listened to this tariff question, because boy, it's delusional, actually. And I thought Powell would have a better answer for this. Pretty much there's tariff inflation and we got to wait and see. It's coming, dude. That's the problem also with the SEP. Like I said, it doesn't take into account any logical forecast, any logical expectation for the future. It's just like best case scenario. And that's what it's supposed to be. As Joachim pointed out, it's supposed to be a way to influence the economy and be forward guidance. But man, oh man, I mean, I could be a Federal Reserve president and do really great SCP forecasts. All I do is let's draw a best fit line from here to 2% on GDP. Let's draw a best fit line on here to 2% on inflation. And every single time, that's what I'm going to do. That's literally what it is. Oh man, I really dislike this answer on tariffs.
Policy response.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well.
And you don't know what the underlying economic environment will be. What about this? What if we're going into recession steeply, rates are falling, prices are falling, CPI is falling, and then they slap some tariffs on, and prices might be affected upward a little bit, but what's the end result of that? See, the problem with thinking about inflation as prices, it's just, one, it's outside of their bounds. As with monetary policy, yeah, it is actually their mandate, stable prices, but it's outside of their tool set. So you don't know what the tariffs are going to be. You don't know the effect of the tariffs. You don't know what the underlying economic environment's going to be. You don't know what's going on with regular prices. And so it's just crazy. It's just like, I don't know. I think this half of the answer is better than the first half, but it's all mixed up, man. They put the Fed, the mythology of the Fed, you put them on a pedestal and they have all the answers. Powell should know how tariffs are. Of course, like if you listen to talking heads on CNBC or on Twitter, these macro accounts that think they're so great, and then they say, of course, tariffs are inflationary. Of course, tariffs are going to cause prices to go up. But you don't know that at all. The underlying economy could fall out. Then what happens with crashing CPI and tariffs? Is it going to cause prices to actually rise? And what does that matter? Like, that's not inflation. It's actually deflationary. So actually, tariffs, coming to think of it, if we're going into recession, it would be actually a big misstep to put tariffs on, because just like the oil conversation I've had many times here on the live stream, when you restrict production, so OPEC has, is producing almost 6 million barrels per day below their total capacity, which is roughly 5% or a little bit more than 5% of global oil production is now offline, and yet prices are still low. So you have what they did that to keep prices higher, right? To keep their bottom line. But all that does is hurt the consumer, because the market wants prices to fall. The consumer market wants the prices to fall. Then they can have some excess money. Like, let's say instead of spending $200 a month on gasoline, or even $300 a month on gasoline, depending on your commute and stuff, you're only spending $150 or $100. You have a little bit extra room, right? And businesses that have trucks, and the trucking companies, and oil prices and everything on every spectrum of the economy. If that drops by, say, 25%, imagine the savings throughout the economy. And that will help the economy recover. But if you keep prices high, all you're doing is you're entrenching the recession. You're hurting the consumer more. And there's going to be the downturn is going to be deeper, and it's going to be longer. So bringing that idea back into tariffs, if prices want to be falling because of it's a recession, and then you slap tariffs on and you keep those prices higher, the consumers want to heal. The economy wants to heal with lower prices. But the tariffs will keep that from happening. So then you can have a problem with hurting the consumer base and making the recession deeper and longer than it else otherwise would be. That obviously should remind you of Smoot-Hawley tariffs back from the 20s. I think the end of the 1920s. When were they put on? Let me just double check that. Act of 1930. So right after the Great Depression started in 1929, they slapped on these tariffs. Prices wanted to come down, all right? But these tariffs increased prices. Well, I don't know. It was a different situation. We've talked about this recently as well, because the U.S. was a net exporter. So it probably didn't harm price. It probably made prices fall faster. But anyway, that's more for another time. We can take a look at that. But overall, the Fed has no role in tariffs. Their monetary policy cannot address price increases from tariffs. I mean, the most they can do is be more easy on monetary policy, which will actually accelerate inflation. At least that's the typical understanding. So anyway, okay, let's continue.
I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Who's next?
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25, so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have.
To be honest, guys, I was looking at the comments, looking at Telegram. I need to rewind this. 112. We're already going long, but you guys are here, so thanks for joining. Let's get into Nick Timmeros. He's known as the Fed Whisperer. So let's listen to his question again. Sorry about that.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25, so that the central tendency runs from 2.5 to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So
he's asking, inflation is looking good, but why are you cutting? It's actually a little bit estimated to rise, SCP to SCP. So why would you be cutting?
we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling, so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points, so it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And, I just would...
Okay, this is a boring one. Let's go up, see when we can get to the next question.
So we look at that, but we look at...
Much change in mortgages, auto loan.
Have a much clearer picture, I think, when that happens.
Mike.
Michael McKee from Bloomberg Radio and Television. even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is, most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially.
Again, I'll say here, he's talking about GDP, and of course we know that GDP is boosted by the insane deficit spending that we have right now from the government. So it's not a very good measure. If you handicapped government spending a little bit, we would be probably down at 1%, or looking very much worse than the 2.7% that he keeps saying. I do like the question about long-term rates. Again, that's one thing I've been surprised at. There is some misunderstanding that higher rates are bad for the economy. It's actually the exact opposite, that when the economy is stimulated or optimistic, rates will rise. Okay. So the reason that's the interest rate fallacy. You guys can go on my YouTube channel or whatever, find that video. You go on bitcoinandmarkets.com, find the interest rate fallacy. I've revamped it just recently, but optimism makes long-term yields rise. And what has been occurring lately? So we had the rate cuts, which could be seen as optimistic, interpreted as optimistic. You have the Chinese stimulus, multiple rounds and multiple promises and about Chinese stimulus, major unprecedented Chinese stimulus. And then you have the election of Trump, which is very much so bullish for the economy. So you have multiple things happening since September that can be pushing an optimistic long-term view. So even if we do have a recession here, what the 10-year yield is telling us is that, we might have a recession for a year, maybe 18 months, but then it's going to get over it. And Trump is in office and, things are going to pick up. So the U.S. economy is going to pick up. So that is fairly optimistic about the future and about the long range or long-term projection for the economy. So that's what I would say is influencing the 10-year. Of course, when we have an imminent crash, then you're going to see a crash of the yields as well. All across the curve, they're going to crash down. So this is just a temporary rise right now. Where the top of this rise is up for debate. It is not the case, however, that rising yields means that people are turning away from the dollar. They're turning away from the US dollar debt. Because think about this. We just saw a big rise in the DXY. The DXY is strengthening. And we went through the de-euroization, not de-dollarization. All the other currencies are hurting against the dollar, the yuan, the euro, the pound, the Indian rupee, the Japanese yen. All these things are weak versus the dollar. So it doesn't make any sense that we have a strengthening dollar, but somehow people are turning away from the US 10-year. That those things don't match. What you have to do to make those things match is understand that higher rates are actually optimistic. Then you can be like, okay, that does make sense, because if the US economy is on fairly good footing or better footing than Europe and China and stuff, the money is going to be flowing here. I just saw another chart that showed the US stock market versus all combined stock markets of the world, and the US stock market is higher, it's worth more. It's like 64 trillion versus all the other stock markets in the world combined are 62 trillion. And it's rapidly going higher relative to the other stock markets. So you have the US economy in a relatively strong position. So what's going to happen? People want to hold dollars. Dollar goes up. It's somewhat optimistic about the US economy. So yields go up. See how that fits together? So you got to rewire your thinking a little bit. Let me take a break here. We're at an hour, 26 minutes. This is a very long live stream. Haven't even got to the Bitcoin question. So if you're joining, we're about to go to the Bitcoin question. I don't know how many more I will take. Probably no more are very interesting. We have a couple people left in the front row. But then we'll get to that Bitcoin question. If you're watching on X, jump over to YouTube or Rumble. It's easier to comment and subscribe and stuff. There was a comment a little bit earlier from Justin on Twitter saying, hey, looking forward to the Bitcoin question. I'm getting there, man. I'm getting there. Thanks for hanging in there and joining us. Let me take a look at Telegram. The only thing I saw here in Telegram was Joachim saying there's a lady in the back of the crowd wearing a mask still. Oh, man. Yeah, that's funny. Okay, so let's continue, or should we just jump to the Bitcoin question now? Who's next? Leesman follows up. They're doing some talking here. Let's just jump to this lady.
Thank you, Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So
yeah, the public sector is where most of the employment's happening. Public and non-native workers. Like if you look at the native workers versus non-native workers, all of the net job creation of this last administration has been for non-native born workers. And I'm just saying that there's a problem there. I'm not saying they shouldn't have jobs. I'm saying there's a problem with that. Okay. And also when you look at public sector, it's going crazy with jobs versus the private sector. So again, there's a problem there. But anyway.
So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front? Or is it just about there being more upside risk to inflation that now needs to be accounted for?
Okay, I'm just going to answer for him that it's about balance, lady. It's about balance. Slightly higher inflation, roughly the same. So we're not going to cut 50. We're going to cut 25. It's balance. That's all there is to it. All right. Let's see if she asks a follow on. I hate it when my computer's slow and it won't go on here.
Job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So but you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or...
Okay, blah, blah, blah. Why can't I see?
Mr. Chairman, I did not hear you
Still
use
the
the
front
word
row.
recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming a phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I
think if I pause it, let it catch up, it will let me see the future. But let me just check the comments here. 233 people watching. What's going on, guys? Put your comments down below. You can send them in on X or YouTube Rumble, or easier to do the live chat, so you can do that. Let's do Telegram, see. Umbracious says, is answering if rate cuts mean money printer go burr. That's what it's supposed to mean, but that's not what it means. Rate cuts mean, well, if you go back pre-Volcker, Reagan's chairman of the Federal Reserve, they were the opposite. So they thought that lowering interest rates was restrictive and raising interest rates was accommodative. Literally, you can go back and look at the Fed funds rate and then put the recessions on there, and you can see that they raised rates when the recession was hitting because they saw that as being accommodative. Then all of a sudden, Volcker created this mythology about breaking the back of inflation. How are we going to make this? How are we going to make this narrative work? We're going to raise interest rates to break the back of inflation. And inflation naturally topped and came down, and Volcker took credit, but he switched the roles. He switched the direction. So now raising rates was considered restrictive and lowering rates was considered accommodative. So that's why most people think that lowering rates is money printer go burr. That's not the case. Low rates actually mean the economy is slowing and fewer people are demanding loans, and banks are tightening their standards. And we can see this with the SEP. It's a little bit noisy after COVID. We looked at that on Telegram the other day. It's a little bit noisy after COVID, but generally the idea is when times are bad, people tighten their belts. They don't want to take out new loans. They don't want to buy that car this year. They'll wait till next year and then they'll take out an auto loan or whatever. So they don't take out loans. There's less demand for loans, and also banks are tightening their credit, their standards. And so that's what happens when rates, and then the result of that is rates fall. Okay. So tight credit is actually associated with falling rates. And that was the case until before Volcker. And then Volcker came in and he kind of changed that around, and now it's the reverse, or it's seen as the reverse, but it's still not the reverse. Okay. So anyway, that's what I would say to that. All right. I want to find this. I can't see where the Bitcoin question is. So we're just going to have to crank up the speed.
Mentioned 12-month, I think it's 12-month headlines, 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil. Thanks, Chair. Chair Powell. Neil Irwin from Axios. Financial markets have been very
I think this guy's one asset.
buoyant really all year.
Yep.
Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course. That's part of what we do. But, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of, just take the last year, we've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restricted. We can also look more directly at the parts of the economy that are affected by...
Did you hear what he did there? He took credit. He took credit. So the rates are coming down, blah, blah, blah. So we know our policy was restrictive. Well, what happens if it naturally came down? They just take credit for what naturally happened.
that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want.
We think it's transmitting. Remember, they use this term policy transmission, where they're from from where they are to the economy, like this meeting right here and their decision to the economy? How is that transmitted? Now, the answer should be fairly straightforward. I had to tell my kids to shut the dog up. Stand by. Okay. Now, if it was like the Fed is in control, then it should be easy. Oh my God. All right. God, Lord, golly. Monetary policy transmission. So if it was the Fed in control, like most Bitcoiners say, and many macro pundits and many sound money people say that the Fed is the big bad, the Fed is the evil thing out there, and they're in control of everything. If that were the case, then that monetary policy transmission would be mechanical. They would do open market operations. They would raise and lower the money supply. They would raise and lower the interest rates mechanically. But it's not. And by them saying here, we think the transmission is doing this, we think the transmission is doing that. They study the transmission of monetary policy to the economy. That doesn't make sense under a mechanical view of the Fed. It only makes sense if they know deep down in their, smoky gentlemen's lounges that they hang out in, the big bankers smoking their big cigars, and they say, ha, 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 ha. We're going to say that we're going to lead them to believe that we're mechanical and what we're doing is affecting the economy with the interest rate policy, but we're going to actually study the monetary policy transmission. So, yeah, it doesn't make sense in that mechanical world. It only makes sense in the world of influence, of forward guidance and massaging the narrative. So there you go. This is the guy that does the Bitcoin question. So Justin, we're finally there. I hope you hung out with us. I think it's been about a half hour since you asked the question, but yeah, we've been live streaming for an hour, 38 minutes, guys. 243 people watching. Welcome. Bitcoin and Markets. Check out the YouTube and Rumble. Check out the pinned tweet. And bitcoinandmarkets.com is my webpage where I do a newsletter and do other blog stuff. So let's continue and listen to the Bitcoin question.
A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
All right. So that was the big one about Bitcoin, that they can't hold Bitcoin. I'm not sure of the actual language of the Federal Reserve Act. Maybe you guys on Telegram, since you're on your stuff, you can look that up. What did Joachim address that? Yeah, about the gold. Yeah, the main idea is this: the Bitcoin reserve is not to be held by the Fed. The Bitcoin reserve is to be held by the Treasury. And the initial phases of the Bitcoin reserve, of course, we have the Lummis bill in there. And I think the Lummis bill is talking about the United States government and not about the Federal Reserve. It's talking about the United States government. And the idea would be to keep the 200,000 that they already have and plus that up to 1 million within 5 years. And so the Treasury would just be buying Bitcoin basically and putting it in a strategic Bitcoin reserve. This would not involve the Fed yet. And yes, it would need a act of Congress to force the Fed to hold Bitcoin. But that will come with a monetary transition. Of course, if we're going to do a big monetary transition, like we've done multiple times in the past, the last one, the big one was 1971. We also had a Plaza Accord. I think that was in 1980 or 81 when they came together and they said, we need to globally, we're going to devalue the dollar because it's getting too strong. That wasn't technically like changing the money. It was just like a coordinated effort to weaken the dollar. So a change in the monetary system happens every few generations. And if we come to that point, which I think we will, yes, it will require an act of Congress. We knew that already. This wasn't really a wow moment. It was just that, hey, he mentioned Bitcoin kind of negatively. Joachim says, they used to only hold government bonds, not private securities. Blew that out of the park with asset-backed securities. Oh, there you go. In 2008. And maiden lane lending to private banks, etc. Then again, after COVID. So whatever the law may or may not say about which assets they can hold doesn't seem very binding. That's a great point, Joachim. DT. You keep hearing talk that the government needs Congress to approve buying Bitcoin. That's got to be bullshit. Right. The government can do this. At least the Treasury has the stabilization fund that they can use. I think it's roughly 200 billion. So they can use that 200 billion to buy Bitcoin. They probably wouldn't use all of it, but they would be able to use that in the meantime as they're getting something passed through Congress. And, Congress will move fast. So a lot of people think there's a lot of infighting and there's a lot of people fighting Trump and all this stuff. But really, I would say half of the Congress is relatively friendly to Trump at this point. And those people that are holding out, they're going to switch as well, most of them probably, on Bitcoin when they see the UAE has a strategic reserve, when they see China and Russia. They get some classified sort of briefings and they say, look, you guys are behind. These guys are already moving. They're already doing this. I mean, look at the tariffs. The tariffs were a partisan issue. Well, first they were a Democrat issue decades ago. They wanted tariffs. The Republicans didn't want tariffs. Then it became a MAGA issue. MAGA wanted tariffs. Democrats didn't want tariffs, or they hated everything MAGA. But when Biden came in, he actually raised tariffs a little bit. So on top of what Trump did. So, the one thing that people are very aligned on in Washington is tariffs, anti-China stuff. And this Bitcoin stuff can be right within that wheelhouse as well, where there's wide agreement. And that agreement can happen very, very quickly because of outside events that happen in the world. So be watching out for that. DT, the government has a deep history of doing all kinds of crazy stuff without involving Congress. Yes. Well, that's true. So like some of these agencies could buy their own strategic reserves. The CIA could buy their own strategic reserve of Bitcoin. Very good point. And, let's say it doesn't get passed in the federal government immediately. It will be passed in some of these states like Texas. And Texas is a big economy. On its own, it's the 8th largest economy in the world. So that is a big guy, one of the big players, bigger than Russia. Their economy is significantly larger than Russia, larger than Italy. And so if Texas does this, that's also very, very positive. And I think Texas would have at least a clearer ability maybe to do this, less impact than the United States government. DT, they side with Jason Lowry ideas. They bury it in military spending. That's also a very good point. Military, well, I don't know if they would have a reserve of that, to be honest with you. They might have a budget item and slowly stack or something, but they're not going to have any sort of major strategic reserve for the military. But I can see the CIA doing it, maybe the FBI, some of these NSA, some of these other intelligence agencies and stuff. Military, I would say that's probably less likely. But yeah, there's a lot of room for this. If Trump really wants to push it through, he can do it unilaterally. But probably, I don't know if he wants to do that. But like I said, consensus will shift very quickly once it comes out that these other countries are buying. So we'll see if that does come out. All right, that's going to wrap it, guys. We finally got to the Bitcoin question. Let's see who's joining. 252 people. Welcome, Bitcoin and Markets. I live stream here. I try to live stream Monday, Wednesday, Friday, roughly around the same time, towards the end of the business day. So join me for that. You check out bitcoinandmarkets.com. I'll go there right now. Bitcoinandmarkets.com. I've been publishing these as podcast replays. So those don't go sent out with this email because I usually drop those relatively close together and I didn't want to spam your emails, but those are published here. I also have the fundamentals report that comes out every Monday. It's the most comprehensive Bitcoin newsletter. You guys can check that out. Also have premium content if you want to support the channel and get a little bit extra. This week, I want to get out a premium post about price. So near term, medium term, and long term forecast for the Bitcoin price. And I do blog posts as well. Like this one, I think is very valuable. It's answering the critics of the Bitcoin reserve bill, looking specifically at some of the mainstream media pundits that are saying, oh, it's bad. And these are all different things. But I look at sources of funding for it. I look at Bitcoin as a nonpartisan issue, libertarian commitment to sound money. Bitcoin is not speculative as you think. What are these other parts? Bitcoiners want to accumulate, not offload. Bitcoiners don't need a bailout. Bitcoin is the best defense in a changing monetary landscape. So that's the type of stuff that I put out. And yeah, check it out. Bitcoinmarkets.com. Sign up for the free tier, or there are ways to support the show there. So, all right, last thing before we go, let's check out the price. This is the dollar. I drew this last Friday, this red line, and it has been following this breakout pattern, stronger dollar. Okay, but let's go to Bitcoin. Trying to hold on to that $100,000 mark. I think it can. Bottom of the channel here, if we bring up the EMAs or the moving averages, these are standard moving averages. 50-day here. So tons of room. 200-day, or sorry, geez, 20-day. That is right there. That's also the middle of the B bands. If you bring up the Bollinger Bands, that is the middle of the Bollinger Bands as well. So we're still in the top half of the Bollinger Bands, which is a good thing, meaning we're generally positive. Nothing impactful at all on the chart here. So we are still completely intact on a bullish run. And look how fast these things turn around. So we had this big dip, and 2 days later we were back up. 4 days later we were pretty much retraced the whole move for the big dip. This big candle here, well, this big candle topping out at 103 went all the way down to a low of 92. So $10,000 candle here. And within a couple of days, we were right back up there at the top. So this big candle, absolutely nothing, no damage on the chart whatsoever. Nice area for support with some different things coalescing right here on the Bitcoin price, right around 100 too. So not only do you have the 20-day moving average, you have the channel, the bottom of the channel, and you have the $100,000 round number that is going to attract bids. So there is a lot of stuff going on right here. This is probably going to be actually some fairly significant support. Before I go off of this, let's take a look real quick at the cloud. Also, the top, this is not the key June, but this is the daily cloud, and this is the Tenkin that's right here as well. So that's another area of support. Standard Cloud, Key June. So these are different timings, different indicators I look at. And how about, well, that's all I'll look at for today. Okay, let's stock market is another one that was affected by this big sell-off. Wow, look at that candle, guys. Holy cow. Stock market really selling off. This is a big statement candle. I wonder what people are saying out there. If you guys can comment what people are saying about this FOMC meeting. But this is a significant level of support that we're hitting right now. And after this, we're talking down here. So that's pretty big candle, big statement on the day for the stock market. Remember, pre-recession trade that I've been talking about for 2 years was bullish stock market. The imminent recession trade, which I'm not ready to say is on yet. Okay, depending on what we see here with the stock market, but this could just be a correction. I mean, we've gone a long way this year on the stock market. So the imminent recession trade is going to be negative for the stock market. That's what we're kind of waiting for. All right, let's do oil down on the day. Dollar we did. Gold, big down on the day. Dollar is getting stronger. So the strong dollar is affecting gold here. And you could say it's affecting Bitcoin, but not really. I mean, I don't think there's that big of a link here between the strong dollar and Bitcoin. Bitcoin is getting into being a defensive asset. So that's how I'm seeing it. All right. So back to the website, bitcoinandmarkets.com. Check it out, guys. Thanks for joining me. One more check of the Telegram. I'm not seeing any other comments. So long live stream here. Thanks for joining me. And hope you guys have a good rest of your evening. And I'll see you on the Telegram channel or on a live stream on Friday. All right. All right. Bye, guys. Have a good one.